Good morning, ladies and gentlemen, and welcome to the ELECO PLC interim results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it is appropriate to do so. Before we begin, as usual, we would just like to submit the following poll, and if you'd give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to CEO Jonathan Hunter. Jonathan, good morning, sir.
Good morning. Thank you, Jake, and good morning, ladies and gentlemen. Delighted to present ELECO's interim results, which is a record growth in terms of interim results and demonstrates positive momentum in the group strategy. I'm also joined by our CFO, Neil Pritchard, who many of you would have met in previous meetings. Some of you may be new to ELECO, so I would like to take a few moments to introduce the group and also be a reminder for those who do know the story. ELECO aims to be a trusted technology partner in the built environment. We address mission critical areas of the building life cycle, from early planning, and that relates to project planning and time and task planning, and estimating, through to project delivery, maintenance and operations. Our solutions are best of breed, meeting the needs of a diverse audience within that building life cycle and allowing them to prescriptively schedule, collaborate, report, manage, and also meet compliance and safety regulations. The group at a glance, ELECO now comprises just under 300 colleagues, and they're based in the UK, throughout Europe, US, Australia, and Romania. Our core markets remain the UK, Scandinavia, Germany, Netherlands, and the US. And within those markets, we primarily sell direct to customers. So as you can see, 96% of our revenues are direct to customer and 4% is through indirect reseller channels. We're very proud to share that 74% of our revenues are now recurring SaaS and subscription contracts, and that's continuing to grow, and we'll present some more detail on that in a moment. 4% of our revenues are perpetual license and 22% is through services. And on the slide there on the bottom right, you can see our key market positions. We're very well positioned within our home markets, despite this, and having fantastic lasting relationships with loyal customers. We still continue to expand within our customer base as the industry and our customers are progressing through their digital transformation journey. So I shall move on to the strategic progress we've been making in the first half. And we're really pleased to demonstrate, and the results are showing it, solid momentum alongside our strategy. We continue to innovate, and we release some new products in the first half, including Aster GPT, which is a generative AI application offered to our customers, helping them adopt the use, solve problems within the software, but also adopt the software a lot quicker for new customers and new users joining the platform. We also introduced a collaboration functionality within our Aster Vision platform, which is fantastic in terms of sharing in a secure way, working together on complex project schedules. And also the platform allows for data to be prescriptively stored and measured, which is really fantastic for our customers, because they get real-time dashboards, but also very clean, high-quality data, which will drive and fuel their AI ambitions in the future. In terms of strengthening the business, it's a key pillar to our strategy. We want to ensure that ELECO is a future-proof and a resilient platform that allows us to invest in innovation and future growth. And with that, we perform really well on our ESG targets. We've had really high retention rates in our staff and talent, and we continue to attract new talent to the business, which is really exciting. There's a lot of focus on customers and customer centricity, ensuring that we're nurturing our customer relationships. And we've introduced further customer success capabilities and continuing to develop future capabilities in a learning management system. We remain very sticky within our customer base, and retention rates are very high, which we're very pleased to see. We also made a small acquisition in the first half of a company called Vertical Digital, which strengthens our team. It was an acquisition hire in terms of R&D, a very experienced and profitable R&D business, and it allows us to invest in R&D in areas where we may not have had the capability, and also complement some of the requirements that our customers have as they're implementing technology within their businesses. Our growth plans are focused on regions and ensuring that we are meeting the needs in a customer-centric way within each region and appealing to their needs as well. We've invested further in the US in terms of marketing and sales capability, and we're pleased to see the momentum starting to develop there. Go-to-market is a key pillar to our strategy, which I'll present and share with you later on, but we're continuing to see good progress with sales enablement activities continuing throughout the year, ensuring that all of our sales colleagues are learning and taking the best lessons learnt within our organisation and sharing those and applying those. And as always, when we're looking at our M&A and future M&A prospects, we're also considering what we will need to develop in terms of our roadmap and who we could potentially partner with to solve problems. And with that, we continue to sponsor the Construction Tech CTech Club, which comprises over 400 founders and construction tech businesses around the world. It's a unique club. It's one unique club and also growing and expanding. So really great things going on there and really great insight for our colleagues as well. So I will hand over to Neil to please ask you to take viewers through the interim results, the financial results.
Pleasure. Thank you very much, Jonathan. Good morning, everybody. Thanks very much for joining. Incredibly pleased to present the interim financial results for the 6 months to ending 30th of June 2024, and obviously against the comparative half year as well. So this first slide is very much the financial highlights, if you like, the news headlines, and I'll go into far more detail on the P&L, the revenues as well, the cash, and finally the balance sheet. But first of all, just to head off at the very start on in terms of these highlights, as many of you know who've been following us, we've been on a sort of financial SaaS and subscription revenue journey, moving from perpetual one-off licenses to a recurring model that provides greater predictability, forecastability, and shareholder value, and indeed, strength going forward for the group. And we're really pleased to say, as we now move into this very latter part, that some of those fruits of the labours are really showing through. So on the top level here, what you can see are the revenue metrics. And first of all, we can see annualized recurring revenues, ARR. And that's where you take the last period of the last month of the 6-month period and you multiply them by 12. It's often used as an exit measure, just then as a useful forward-looking measure and as an indicator. And what's really pleasing to see is obviously that's moved ahead by 31%. And that was, if you looked at where that was going at the first half of 23, the comparative period, that was at 18. So now if you actually strip away the acquisition effects, and briefly let me just explain what those are. So first of all, Jonathan mentioned Vertical Digital, which was our remaining acquisition that we made in mid-April. So there's 2.5 months worth of relatively minor external revenue. It's obviously a purpose for internal R&D capability. But also there was the first half contribution of Best Outcome, which was an acquisition we made and took place really from the second half of 23 onwards. So therefore the first half of 23 didn't have it in. So when we talk about the organic numbers here, what we're doing is stripping out the effects of those acquisitions had they not taken place. So you can see that even by stripping those out, the ARR moved ahead by 22%, which is incredibly encouraging. And then the next measure is total recurring revenues, and that's really looking at all the recurring revenues across the 6-month period within the overall revenues and the growth of those. And the recurring revenues across the 6-month period, as you can see there, were up 24%. And again, up 14% if you take out those acquisition effects. So that's really, again, very, very encouraging. As Jonathan mentioned, we're now nearly 3/4 of the group is on a recurring basis, which is a fantastic platform for the future. And overall revenues as well, it's really, really interesting. So for those who, as I say, that follow us, last half year, we sort of anticipate it might be roughly flat, but actually slightly better than that. This time around, you can really see it coming through now on the overall revenues and where we are. So overall, as you can see there, up 21%, 22% on a constant currency basis. And even on an organic basis, more than double-digit growth, which is much higher than previous levels prior to this and many other initiatives that Jonathan and the rest of the management team, and indeed all the colleagues, have been working so incredibly hard towards. So really good news on the revenue side, to recap on that. Now, on the bottom side, you can see mainly cash and profit related measures. And you can see that our revenues continue to generate very high gross margins as a proportion of the business, over 90%, which is really pleasing to see, and a great indicator, again, of the value that we provide to our customers. What's really interesting, because there was a one-off disposal of a sort of non-core business in the first half of last year. So like for like at the operating profit level, actually things are ahead 36%. And then you can see the various other measures there, 27, 22, and so on. I mean, that's actually adjusted for things like share-based payments and acquisition expenses and things like that, the straightforward things. So actually on the statutory measures, they're much higher. EBITDA up 30%, profit before tax up 23%, profit after tax up 30%. So what you're really seeing is the effects of the improved operational gearing and a lot more things on the whole business really firing on all cylinders, which is really, really, really good to see. And consequently, cash generation has been really excellent. I'll come back to that later in terms of the detail. We're slightly ahead of where we were at the year end, up to 10% on the year end figure, not the half year figure. Had we not made that remaining acquisition, we actually would have been 22% up, so very much in line with the sort of profit and the cash generation of the business. And then finally, really, on the interim dividend, we're very conscious that we've had some very supportive shareholders through this transition, and we're very grateful to them, and we do know there's a multitude of sort of both a measure for income as well as capital growth. So building on the 14% interim and final increase of last year of the dividend, we've actually raised the interim dividend by 20%, akin to some of those measures. Just moving on, if I may, then to the P&L in a little bit more detail. I'm going to come back to the revenue on the next slide, so I'm not going to go huge levels of detail there right now, if I may, but I'll just sort of pick through a few other things where we're at. In terms of some of the other lines that you can see there, amortization slightly higher, capitalization slightly higher. That was bringing in the first time effects of Best Outcome, one of the acquisitions where there is development investment that goes on. We've got sort of acquisition expenses relating to both acquisitions in both periods, if you like. Share-based payments, very little changed. The main really change on OpEx, while it's increased, is if you actually take into account the fact that we've absorbed the fixed cost bases of those two acquisitions. If you then strip those back out, what you have, other than a few other sort of minor elements in terms of scaling up of the business in terms of planned budgeted headcount, is very much around the inflationary levels of our operating costs. I've mentioned about the operating profit and the increased gearing that we're seeing in the P&L, and other than sort of finance income, slightly higher effective rate of tax, really around the fact there are sort of higher tax rates in some jurisdictions. There's a little bit more deferred tax effects on some of the acquisition intangibles that's taken in. The gain previously was offset somewhat in the previous half year, which reduced the effective comparative figure a little bit more than otherwise would have been. So what that then leads to overall is, that improvement you can see in profit after tax and also EBITDA. So really very welcome to see, as I say, that level of operational gearing. Now a little bit more, if I may, on just the overall revenue detail, a little bit more detail, because it's quite interesting to really look through a little bit deeper to see what's going on within the business. And what you can see in the first chart on the left hand side is those recurring revenues are very much that central column. You can see that 74% of total revenues. Perpetual has reduced down somewhat further, as we would have anticipated, although there were some other, it can be lumpy, there can be some one-offs in there occasionally. Most of the business is on that recurring side of things. There are some small elements that, while they do have recurring nature, always lend themselves in terms of the way they go to market with customers in terms of the perpetual side of things. I think the really also another one that is of particular interest there is on the right hand side in that first chart, is that we've started to see the other services income, which is predominantly training income, really come back nicely. It's a trend we started to see towards in the second half and in the year-end numbers for those, again, who followed us. And there is an element there of the remaining acquisition for the services income, but even if you strip that out, that's really nice to see that has come back, and there's been a huge amount of effort to flex and improve the offer for customers there. And I think, the macroeconomic headwinds somewhat have alleviated, or certainly some of the uncertainties around. That's the one bit that we occasionally do see deferral or some slight chipping away at in more uncertain times, but it's really good to see that coming back. In the central area there, a couple of things, really, just to say the focus of the SaaS transition has been the building life cycle, the greater part of the group, and that while all parts of the group have increased, overall the building life cycle has grown there to be a bigger proportion, sort of like 72%. There's a little bit of other as well, where we act as a third-party reseller. And we continue, like for like, actually, more or less predominantly selling direct to customers, as you can see there, 96%. On the right-hand side, this is another interesting one. I think where we've seen really nice growth, and actually outside of the currency effects of the Swedish krona, even in local currency terms, Scandinavia has improved as well. So actually we've seen improvements across the board in all geographical customer jurisdictions. So the UK there, Scandinavia I've mentioned, Germany as well, despite some uncertainties that were there. And of course we did dispose of the German business, as I said earlier. Rest of Europe now includes Romania, so that's one element just for full transparency, but nonetheless it's still moving ahead very nicely. US shows continued growth, as Jonathan mentioned a little bit earlier as well, and we'll come back to, and rest of world. So really encouraging to see all that sort of revenue advancement across the whole portfolio. Just moving a tiny bit on further then to the cash, and for those of you who know us, I've mentioned the high gross margins before, and the recurring revenues obviously is a feature and a greater feature of the group. And the retention rates, Jonathan mentioned, we have high retention rates. So, but we do have very good cash generation, and you know, as a business, we don't have to have huge inventories of widgets or something else to scale up. So it really does provide an opportunity for future growth to be able to do so, and kind of self-fund in respect of our ongoing innovation and R&D. So a couple of really interesting stats. I think first of all, the cash generated from operations has gone from 2.8 to 5.8. It's gone up 3 million in the first half. The free cash flow has doubled from 1.8 to 3.2, which is, as you can see in the bottom left, an improved proportion of operating profits on what was otherwise still a very, very good measure. So it's really interesting to see. The breakdown on the right hand side is kind of very much follows the sort of the main movements that you see in the cash flow, but kind of visually is a good aid to see that. And clearly we've had some improvements in terms of working capital scaling up in the business, about 0.2 in debtors, 0.4 in payables, and a lot more in deferred income that I'll come back to in the balance sheet slide next. But in terms of we pay a little bit more tax because sometimes you predict forward your future numbers, so you end up having to pay on account. Those are shown as current assets in tax assets. So that expenditure is slightly higher than it was in previous times. Likewise, we've got the acquisition and small acquisition expenses relating to vertical digital, so that's no surprise there. And we have an ongoing continual investment in development. That has, for those of you who know, we do have very prudent measures, which I can expand upon later in terms of how we do capitalise. And obviously, we've got a great platform, a long developed, trusted platform with our customers' high reputation that we can build upon for innovation overall. We did increase the final dividend that was paid in the first half, so that's an element there that you can see in the cash flow. So overall, and of course we have no borrowings at present either, so we do have really nice to see that level of cash generation coming through for the business. That adds to the resilience of our balance sheet as well. And then just finally moving on to the balance sheet, if I may as well. I won't talk too much longer for you, but essentially most of the main movements there relate to kind of acquisition related things. So for example, there's a little bit that says there about 0.4 for vertical digital in terms of goodwill, also about another 0.5 for intangibles, predominantly customer relationships in vertical digital. We've talked about the current tax. I suppose we've effectively talked about the cash. The deferred income is higher by 18%. Then again, that's sort of revenues that haven't yet been recognised, but if you like, another good lead indicator of where we're going with things. So really nice to see that. And overall, obviously, improvements on net assets and balance sheet strength. With that improved cash position, which is now a higher level proportion of net assets, now 43% compared to 40% for the previous one, we stand in very good stead for the future. And thanks very much for all your attention on that. It's been a delight to be able to share all those great numbers. And back to Jonathan.
Thank you. So in this section of the presentation, I'd like to share some insight into the sector that we're involved in, our strategy, and also some customer case studies to share how our customers use and gain value from our solutions. So to start with the sector, it really is a buoyant and exciting market in terms of construction and property technology. ELECO services both the management of complex construction projects, and then also maintenance and facilities management of operations and production lines and manufacturing businesses. So ensuring efficiency and safety and compliance across all the industries. But when it comes to the built environment, there's changes in the market characteristics. There's obviously a demand for new buildings and structures just purely from population growth, and that's international, but also in persistent cost pressures and demands from end clients upon our clients that are building and maintaining, which is leading to complexity within projects, project planning, project management, measuring productivity, and also maintaining as well. The maintenance of properties and structures is considered more and more during the planning, design, and construction phases. And the emerging disruptors are environmental, sustainability, compliance and regulation, modern methods of construction, and also digital transformation. The whole industry is transforming digitally and increasing that pace of transformation and adoption of technology and modernization. And at the same time, the industry is also becoming more complex and the demands are increasing, which makes it very exciting, but also challenging. And what ELECO does is solves many of those customer challenges, and which there are many. And we really provide a great position and mission critical solution for time and task management, which applies to every project and maintenance and facility maintenance as well. So we're really well positioned with best of breed solutions, and the customers really love what we do and what we offer, and always throughout the decades that we've been providing software, the customers drive that innovation, and we work together to ensure that whatever we are developing and offering is meeting the customer needs. That makes us very sticky and also challenging to disrupt and replicate. Our growth strategy is focused on 3 key pillars, but the foundation of our growth is to ensure that we have a strong, profitable, well-governed business platform with good ESG credentials, a great company culture and values, and also people and talent, and a strong reputation as well within the industry as that trusted business that people want to work with and customers want to work with as well. Because we see ourselves as being on a journey within the industry as it's digitally transforming. We're on a journey with our customers to improve and really not just add technology, but change the workflows and the way things, the way businesses operate in a digital environment. And that's why when we look at the middle pillar, innovation and technology, that's where the business is really well positioned. We've got very feature-rich solutions. We understand our clients very well. We were, for those that know the full history of ELECO, we were a construction and building engineering business, and now we're in we've always been in that tech space. So we can inform and work with customers to digitalize and not just digitize. And what we mean by that is changing workflows and changing ways of working to meet the needs, or to ensure they're best suited for a digital environment, not just simply applying technology to a workflow that may be outdated and therefore less productive if digitized. So very confident, and we've got great proven technology. I think that the pillar to the far left, go to market, is really really key for us in terms of driving further growth and expansion within our customer base and geographies, ensuring that the customers and the world know how fantastic our technology is, and continuing to position and invest in our brand and ensure that we retain our reputation within the market. We've had a focus on partnerships as we've been progressing through M&A, and I'll come on to that, more of that in a moment. Also on customer success and account management, so ensuring that our new customers, or customers that are buying new technology and new solutions from us, we're shortening that time to value, ensuring that they gain value as quickly as possible from their investment. The customer satisfaction surveys that we carry out quite frequently just demonstrate that the services and the fact that we listen is a key selling point that's driven their decision to work with ELECO and our products. And they feel that we really understand their problems, and we get to understand what their problems are and how we can help support them. And we're driving that through into our R&D as well with the new acquisition of Vertical Digital. We also appointed one of the founders there as our CTO, Alex Gabrianu, and he's bringing that into our R&D teams, that storytelling from customers, and ensuring our engineers understand the customers' problems and what they're developing technically to solve those problems. So the output is a better quality R&D result. And finally, the third pillar, mergers and acquisitions. We're very much, ELECO has been formed through acquisitions over the years, and we continue that search for value enhancing opportunities and businesses. We're looking at three criteria: type A, B, and C. Type A being revenue growing and profitable businesses that complement our existing customers. We believe that we have good customer relationships and good positions. We want to leverage those relationships and offer more value, and therefore looking at businesses and technologies that can complement that. Type B is proven technologies, perhaps new tech that's entering the built environment, and there is, as we've been searching, there's many new smaller businesses and startups that are coming out of their startup phase into early stage growth, and they're proven in that they've got a few good clients, and we could work together and possibly grow and expand. So those are really quite interesting opportunities, but we're looking at those technology opportunities in relation to our own product roadmaps to ensure that we're enhancing or complementing our product roadmaps, and also identifying what areas of our product roadmaps that we possibly couldn't consider acquisition, and we will develop and invest in R&D ourselves with our own capabilities. So it's very much ensuring and testing that the technology will be complementary. And the next generation type C technology is looking at opportunities that may not be within the built environment and could be in fintech and other areas of payments and different types of technologies that we may be able to introduce into the built environment. Whilst I'd assure you that type A and B is our primary focus, we still feel that it's important to consider and keep our eyes open as to what technologies are in other sectors. So therefore, it is one of the criteria that we're seeking when looking at M&A. Ultimately, we're very conscious of ensuring that the platform as a business continues to strengthen and be value enhancing. So that's why we've got that growth platform across the bottom, and therefore we're very diligent when looking at M&A opportunities. It has to be contributing and enhancing to the group and the future of the group. So I'd like to share two brief case studies with you from our customers, and we love seeing these because our customers very much add their quotes and comments. You can see on the bottom right. The first is from Taylor Snacks, formerly known as Mackie Crisps, and they're a food manufacturing business. They have recently installed our maintenance management software, Shire Systems. And the head of engineering and facilities there, who's recently joined Taylor Snacks, Matt Dunmore, he shared that he loves the product that much that he's taken Shire Systems to every business that he's worked for, and it's been implemented in businesses that have been £20 million in turnover up to £220 million in turnover. So it's whilst he's recently joined there and very happy that Shire Systems was chosen, it just demonstrates the stickiness of the products and how much it's really adding value, and people, new joiners and so forth, are willing to recommend the product and install it and really push for it to be used, despite being new to an organization. So we're really pleased with that, and it's just one example of many. But Shire is very much used throughout the UK with food and drink manufacturers, but that's also expanding internationally as you know, like many of those businesses have manufacturing sites in local jurisdictions as well. And the industry, just a little bit on what we're seeing in manufacturing, is that there's global manufacturing brands are moving to moving manufacturing more closer to their customers. So instead of sending products, you know, across different jurisdictions with increased tariffs and supply chain disruptions and so forth, there's a greater focus on manufacturing products closer to home, and that's really an interesting opportunity for our solution in Shire. But you know, we also service facilities as well, which is a growing demand as well for those businesses. A little bit on the next one, which is Balfour Beatty, the largest UK general contractor, construction contractor. They had been a Asta customer for several years, many years, using our solutions to plan and manage their construction projects in a great amount of detail. More recently, their senior leadership team had requested forensic planning information on their key projects to understand risks, where programs are against where they ought to be, and also ensure visibility of whether those projects will be finishing ahead or behind. And what we've provided and installed is our Asta Vision platform, which more recently now allows for real-time collaboration across those projects. And what Vision is providing is a central location for all project files, but also workflows and templating and sign-offs and so forth. So it is a platform that controls the project data and allows for clean prescriptive data tailored for Balfour Beatty. So it's been set up to meet their needs and their workflows, and of course, appealing to their leadership team that now has real-time visibility in the dashboard of what's exactly happening on site and what should have happened or may not have happened. So really, really exciting. I think really forward thinking as well. Historically they would, the leadership team would have had to wait for a report to be presented, and that could, wasn't real time. It's fantastic to see our customers also adopting Asta Vision as it's the backbone to future AI and analysis on that clean prescriptive data. And that's the real challenge that we see many companies having, is that that the historic data, which is very complex, and it's difficult to cleanse and also determine the quality of that data, and therefore the quality of, once AI and machine learning is applied, the quality of the output. So clean data is very much loved when it comes to considering and implementing AI. So if you enjoyed those case studies, just in summary, we'd like to just share the key points that we're very pleased with the results for the first half. We will keep the momentum. I think it demonstrates momentum. We'll keep the momentum going into the second half. Pleased that the recurring revenues and at 74%, and it's providing predictability of our revenues. And the ARR, which is more of a forward-looking number, that's grown by 31%. So, very good performance, solid performance from our colleagues in the group, demonstrating positive momentum. M&A activities will continue. As a reminder, we did acquire a business this year, and we'll continue to identify and review opportunities very carefully, and in conjunction with our products and our roadmaps and the direction we're taking our technology. And also, we're pleased to be able to increase the dividend at the interims, demonstrating our confidence in the future expectations in the year. So that concludes the presentation. I will hand back to Jake so we can open up for your questions.
Perfect, Jonathan, Neil, that's great. And thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the company take a few moments to review those questions that were submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboard. Neil, Jonathan, as you can see there, we have received a number of questions throughout your presentation this morning, and thank you to all of those on the call for taking the time to submit their questions. But guys, at this point, if I may just hand back to you just to read out those questions and give your responses where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Thank you, Jake. So, and thank you, folks, for your questions. The first is from Adam B. I'll read it out. Great set of figures, well done. Thank you very much, very kind. The only real concern which I had was with the large increase in OPEX from H2 to H1 this year. Were the costs pulled forward into H2 or were they lumpy amounts? How should we think about the H2 OPEX base? So, yeah, great question. Shall I? Neil, would you like to?
Happy to take that. Thanks, Jonathan. Yes, and thanks, Adam, for the question. Yeah, so I did allude a little bit to it in it. I'm happy to provide a tiny bit more detail, of course, in answer to your question. So really, it was about the absorption of those cost bases of the two acquired businesses. You know, of that movement of about 2 million or so, approximately between 1.2 and 1.3 was actually related to that. So other than that, so what we're really talking about is kind of underlying levels that, as I say, we have come from a more inflationary environment. I appreciate it's come down more recently in the UK, for example, that you'll be very well aware of. So the sort of 6-7% that we're then left with is kind of coming from that area. That isn't entirely just because of inflationary demands and so on within the business, although clearly we always, you know, keep a tight lid on that and see what else needs to be, you know, reassessed from almost an XBB sort of zero-based budgeting basis upwards. But also there is an element, yes, we are spending more on some of the go-to-market particularly, and some planned, as I say, budgeted heads and things. This is important because what we need to do is obviously make sure that, you know, we are setting ourselves up rightly for the future, really, in terms of the scale up of the business. And so, you know, it's not just about immediate results and immediate shareholder value. It's about making sure the business is absolutely, you know, world class on a world class stage, and that we're resourcing it accordingly. That is built into the market guidance forecast in that respect. So I might have sort of sent a question another way. So it is. But nonetheless, that's really the main rationale for it. There's other, you know, there's other bits and pieces in terms of the other, you know, slight differences in acquisition related costs and so on. But those are very much one-off, and that's why we do the adjusted measures so that you can, you know, get that clarity on where we're at. So hopefully that goes some way, Adam, towards addressing your question. So.
Thanks, Neil. Another one I'll ask you to respond to. I think you might have already responded to it in the deck, but it was asked by William as to why the Scandinavian revenues have reduced in H1.
Yeah. So I think what we saw last year were a couple of measures where it did go back, you know, significantly. Other than, yes, there would be been an element of some sort of SaaS transition effects back then. Last year, what we saw were a couple of other things. I think it's fair to say, while actually net, it's still underlying growth in sort of numbers of customers and things. We did see in growth terms slightly more Scandinavian customers because they are a smaller nature, so therefore perhaps don't have as much latitude or buffer within their own businesses. You know, they were a little bit more prone, the Scandinavian economies, to their exposures to higher input costs, predominantly energy costs that were coming out of the Russia-Ukraine sort of conflict and so on. That's obviously settled down to a certain equilibrium in terms of what and other measures that they've taken within their economies to address that. And you know, that picture seems to be improving. There's still elements of it, but you know, they tend to have lots of customers, but a smaller customers in themselves base. Also, of course, last year there were end of life products on things like Memo and so on. We had 3 products that actually went end of life. So if you like, the previous scale of the business was lower, and why we took those quite tough decisions to make sure that we maintain, that we focus on a portfolio of solutions that's adding shareholder value, that can stand on its own 2 feet, that doesn't involve cross-subsidization. Cross-subsidization is not every portfolio, every product or suite of products, I should say, needs to stand on its own 2 feet. So we took that very difficult decision, and that sort of led to kind of, yes, headline numbers and theories being down. And then finally, the other reason, which is the one I referred to earlier, if you look at the Scandinavian krona particularly, given that the Scandinavia is serviced out of the Swedish jurisdiction, it's something like 4.5% adverse to sterling, and therefore, had we looked in local currency terms, we would have been ahead sort of 2 or 3% even in Scandinavia. So that's the reasons for Scandinavia. Thank you.
Excellent. And the next question from Rob. The acquisition of Vertical Digital was a significant move. What synergies and strategic advantage does the acquisition bring to ELECO, and how's the integration progressing? So perhaps I'll start with answering that, and Neil, please do feel free to jump in if I miss anything.
Sure.
So the acquisition it was a small acquisition. There's about 17 full-time people there, but with some really fantastic customers, including companies like Volkswagen and PwC and Bank of Transylvania and so forth. But their customers were primarily also, apart from one in Romania, they're all throughout Europe and some in Canada as well. So proven track record in attracting and servicing really large blue chip companies, and offering technology development and consulting and also to those businesses that are in different sectors as well. So the strategic synergies and advantages it brings to ELECO is that it augments our R&D teams. We did, I mentioned earlier that we have identified areas of our roadmap that we will need to invest in, and many of those new R&D items will require different technical capability, not drawing on our existing engineers and capability that we have with our core products. So things like AI and different new disciplines that will require hiring. And what Vertical Digital does was really allowed us to bring into the group that capability, as well as a CTO I mentioned earlier, and de-risk that hiring program and process. The business had been run very well, diligently, servicing high-profile customers, and the team there really also wanted to join a larger group to expand and scale and do a lot more. So finally, I guess the last point is also that the jurisdiction that Vertical Digital is in is we estimated to be 40 to 45% lower cost than our home markets as well. The integration is progressing well. The team are really liked. They've really fit into our culture. I think we have similar culture. They have really high ESG credentials and volunteering and so forth. Good customer and employee feedback and scores. So it was a natural fit in terms of people, and I think the integration, as I say, has gone well, and we're improving both businesses really with the new injection of creativity and knowledge and experience. Next question is from John regarding Asta GPT being shortlisted for Innovation of the Year awards. What additional AI-driven features are planned for the future is the question, and how do you see AI transforming ELECO's offerings in the built environment? Great question, and very, very much. I think AI has been on the minds of many businesses and so forth. I think just to start with the first half of your question around AI features that are planned for the future. We have an AI roadmap. Asta GPT was the first release of that, and why it's so capable and really loved is that it's built on, well, it's drawing from 1.5 million words of really high quality documentation and content that we have developed with content authors for Asta. And that provides high quality output and responses. And that's really the key to having high quality output is the high quality input as well. So we're working with customers. Actually, the industry, I think, is very much embracing the AI opportunity, and they're more willing to share their data and allow us to analyze and interrogate that data and identify trends and so forth. And we're working with customers to also identify what problems they have and what they would like to solve or have answers to develop our AI's capability. So that is ongoing. It is part of our roadmap. We're in line with that. We already have quite a substantial experience in developing AI within our products. For example, Asta for many years has had simulation capabilities in scheduling with Monte Carlo and S-curve capabilities built in. We're seeing some vendors offering that as a standalone solution. We also have AI visual recognition within our views business and R&D teams. So we're quite familiar with AI. I think what the journey is to work with customers to really ensure that the data data and the problems or answers they're looking for are being addressed. And hopefully that answers the second question around AI transforming our offering in the built environment. It comes back to the information that we have. I think one more insight to add is probably that, as the industry is going through digital transformation and investing in technology, investing in AI, they do want to use that for their competitive advantage. So it's important that data is segmented as well, or we have the capability to segment information and data and work with clients. So there's some nuances there, and it takes a company like ourselves that understands and is close to the client, to the industry and customers to really address their needs. The next question was from David S. Given the strong cash generation in the first half of 2024, how would you plan to utilize cash reserves? Are there any large investments in technology or acquisitions planned?
Shall I take that first of all?
Yeah. Yes.
So thanks very much, David, for the question. Look, we're really pleased with the excellent cash generation and the way the businesses and the people within the businesses are performing is excellent. Regarding the utilization of those, then I think it's fair to say that in terms of those sort of high margins, recurring revenues, the kind of ongoing cash generation, that certainly does provide a level of ongoing funding for example, for R&D innovation purposes, which is great. So utilization of the reserves in themselves, specifically for that, is less required, frankly, because of that ongoing generation. And of course, we have a predictability and, if you like, the underpin of both the revenues and the gross margins and the cash generating from that to kind of also, to have that knowledge is a wonderful thing to have. So there may be an instance, Jonathan referred to it earlier, where we do monitor closely through CTEC and other opportunities, what the market is doing, and often there's an interplay here between talking, as we do very frequently, to see what else is out there on the M&A that does inform us in terms of the organics, which still remains clearly the main ongoing focus for the group. So it may be, for example, that there are elements as we develop our roadmaps further and further in greater detail and into the future in greater detail, that there may be a further need that we can't otherwise address through internally, although clearly vertical digital gives us that flexibility. But maybe there's a case to be made for acceleration of some development and so on. But right now, as we stand, we don't necessarily see that to be the case. But I guess I should leave that door open if ever that were to be the case. But I think predominantly it is around M&A. I think it's about, and possibly around the investment on the go-to-market side as well. We do have some really good, identified some further senior hires that come through that will really, do that and build upon some of the great foundations that Jonathan and others have really put through. So I think that remains a possibility. That said, from where I stand at the moment, in terms of the forecasts that go out, and there'll be a reappraisal clearly next year as normal and so on, that's sort of factored in. So then that leaves me back to the M&A front and your question predominantly. For us, other than sort of the type A, B, C that Jonathan referred to and so on, if you were to encompass that, what I would always say is, the acquisition has to make sense. It has to be a compelling strategic fit. It has to be, we're not going to do something that's, going to depart from our knitting and so on, stick to the knitting. But, we are very well diversified yet best of breed in what we do. So we have expertise not just in Contech but also in PropTech, and there are opportunities across the piece actually that we are seeing, and we're seeing more, and we're looking for more and so on, but as I say, probably rejecting more, right? So that it has to be a compelling strategic fit, but secondly it absolutely has to be accretive and add shareholder value. We can see that coming through now, even small period so far for vertical digital, mainly it's repurpose as well, but best outcome and so on. So it's all been it's got to be part of a very sensible, appropriate fit that is obviously customer centric as well and addresses customers' needs for those solutions. The cash can go there. Yes, we have the ability to move into debt, and yes, we have the ability for something very large and transformative to go into equity. But we understand the preferences of shareholders, the order of that, largely speaking, unless the other opportunities present themselves. Occasionally, opportunities present themselves that are kind of probably once in a 20-30 year thing. So one has to seize that. But those are the key measures, the key metrics, the key ways of looking at it, and we absolutely want to be focused and sensible about it. So predominantly, other than those other elements I mentioned earlier, it would be around the M&A use.
Thank you. Thanks for your question, David. And a final question from a different David R. Thank you for your question. It's difficult to gauge the health of the construction industry at the moment, especially where political interference is proposed. Which sectors within construction are currently looking most promising? Which sectors are of most concern to you? Great question. And I think important to, understand our resilience in terms of the industry through we've went through the global financial crisis where we retained customers, remained profitable in terms of the software side of the business. COVID, we fared well through that period as well, and actually elected to voluntarily repay our furlough and pay shareholders a dividend and pay back our borrowings and so forth. So it's challenging when we consider the construction output and the link that back to our sort of operations and business and performance. I think where we do see an impact is in our service line, but the software and the recurring revenue is resilient. So that's, I guess, important to highlight because we don't directly, our revenues are not directly linked to the output in construction. But what we do see is, yeah, as I mentioned earlier, ongoing complexity and challenges for our customers that are delivering construction projects. And sectors that we see as most promising are the general contractors, main contractors, and associated, advisors and engineers and consultants that are working around the scheduling, planning of projects of all sizes, really. I mean, absolutely necessary to use our solutions on complex projects, but also, simple, smaller projects as well. We're seeing a lot of new customers joining, and particularly in the UK as well, where we've got a good market position. We continue to see new customers and attract new customers that are moving from no system essentially for scheduling. They're using, self-made sort of Gantt charts and things and very generic tools. Moving to our platform and sort of on the start of that digital modernisation transformation journey. So that's quite a focus for us to support those smaller businesses and newcomers to CPM to join. But they do start on a low level and then expand their use over time, and therefore, our focus, if you were to ask where our colleagues are focused on servicing, is the customers that we've had or we class as existing customers, to ensure that the product is continued to be used and they're considering expanding and adopting more of the solutions and capabilities we have. And we definitely have capabilities to future-proof their businesses. So, there's still many that could adopt some of the things like the Vision platform I described earlier. We also offer 4D and really capable functionality. So hopefully that goes some way to answering your question, David. Thank you very much again for your question. And that was the final question, so I'll Jake.
Jonathan, Neil, that's great. And thank you very much indeed for addressing all of those questions that came in from investors this morning. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses out on the platform. But Jonathan, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Yes. Well, ladies and gentlemen, thank you very much for joining, and thank you for your questions and your engagement. Really appreciate the kind words and encouragement. We are delighted to be presenting what is a record first half results for us and demonstrating the momentum in our growth strategy. We really look forward to sharing progress of the full year when we meet again next year. But if there are any further questions, please feel free to write in after the meeting. Thank you very much.
Thank you.
Perfect, Jonathan, that's great. And thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of ELECO PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.